assist you in better understanding these two bookkeeping fundamentals, we have put together a detailed comparison of accounts receivable versus accounts payable. What is accounts receivable? The category on a firm's balance sheet or income statement that lists any outstanding sums due to the company by its clients is known as accounts receivable. Accounts receivable serve two purposes in financial statements. They are revenue accounts that display the company's earnings or upcoming cash infusions. These are current asset accounts that show money that is included in the business's net working capital. Any items and services for which the business has generated an invoice are detailed on an accounts receivable ledger. When to use accounts receivable? Accounts receivable is a tool used by businesses to monitor outstanding payments from clients. The ledger records a receivable balance as an asset. The account gets deleted from the accounts receivable list once complete payment has been received. Finance may issue a reminder along with the first invoice and any late penalties accrued if payments are not received on time. What is accounts payable? A balance sheet's accounts payable ledger lists upcoming transactions where the corporation must make a payment to a third party. Accounts payable is a liability account since it reflects the money that will shortly leave the company and reduce its net worth on the balance sheet. Similar to accounts receivable, accounts payable keeps track of ledger items for which an invoice has been generated, with the exception being this time, the invoice is sent to the business. When to use accounts payable? Payable is the best tool for managing costs and amounts owing to suppliers for crucial business operations. After selecting a supplier, a business will issue a formal purchase order, terms and conditions, and delivery date. It might also agree to make partial payments upfront and the remaining payments once the services are rendered. Accounts receivable versus accounts payable. What are the key differences? There are several similarities between the accounting procedures for accounts receivable versus accounts payable. Accounts payable depicts money that will shortly leave the organization, whereas accounts receivable explains money that is anticipated to flow into the company. Accounts receivable versus accounts payable. They are so different in the following ways. 1. Classification. Accounts payable is a current asset account. It reports money that should soon flow into the company. Accounts receivable is a current liability account. It describes money that will soon leave the company. 2. Offset allowances. Offset allowances are based on the notion that some accounts receivable balances might never be paid. These are known as doubtful accounts in accounting. An offset allowance is the amount of money that the business will lose if dubious accounts fail to make their payments on time. 3. Audits. Accounts receivable versus accounts payable are both examined by auditors to ensure openness and honesty, but they are searching for distinct things in each ledger. How to handle accounts payable and receivable. It is best to optimize both accounts receivable versus accounts payable to prevent the cash flow issues that might be brought on by inefficient accounting procedures. Our top 3 suggestions for managing accounts receivable versus accounts payable are as follows. Take into account automating accounts receivable. You can utilize a cloud-based payments platform like GoCardless in conjunction with a variety of accounting software packages, like Xero and QuickBooks, to automate your accounts receivable process. Simplify billing. To guarantee you're including all the necessary information, use an invoice template. To ensure speedier payment, you should also send the invoice as soon as the service is finished. Negotiate fair terms of payment. Remember to maximize accounts payable. Negotiating longer payment terms for your business, which helps to free up cash and increase working capital, is one of the finest methods to achieve this. How accounting software and automation can help. Accounting and automation software helps you automate payment collection, cutting down on the amount of admin your team needs to deal with when chasing invoices. When businesses expand, they typically engage in credit sales, where transactions are completed before funds are transferred. Accrual accounting keeps track of funds coming in and going out even before transactions take place. This is made possible by 2 unique types of bookkeeping accounts: accounts payable and accounts receivable. The yin and yang of business are accounts receivable versus accounts payable. The organization can seize development opportunities and maintain great relationships with customers and suppliers when revenues and expenses maintain a healthy equilibrium.